Hi, welcome to the December call. We're pre-recording this given the heavy Christmas schedule and people's time probably being precious, so you can listen to this whenever. Um, we're going to go through the outlook for 2024 once again. As you can see from the title, Devastation or Liquidity Deluge. That's really the sort of binary outcomes in many ways. We're in the latter camp. We think that it's more likely you're going to see liquidity deluge. Too many people are actually talking about the fact that liquidity conditions may well tighten in 24. I find that a staggering thought, given the fact that from the last FOMC meeting just had, it seems as if the Fed is signaling that we're at the peak of interest rates, and cuts may start as early as March of next year. On top of that, you're looking at central banks everywhere which are inching liquidity in, and we know that China is also pouring liquidity into its markets, trying to restart the economy. So it looks more likely we're going to see a strong liquidity year in 2024. In terms of how we see things, let me move on in the presentation. This is a summary of our outlook. This is the outlook we've been running with through actually most of this year. We think stocks globally are underpinned by global liquidity conditions and falling inflation. The exception there is Japan, where inflation is becoming rather a more worrisome episode, perhaps, as we've noted before in places, pockets. Japanese inflation is up to double-digit levels. And I think that's something that's going to require some change or attenuation in policy and probably a change in asset allocation of Japanese investors. But that was something we explored last month. China, as we note, is easing. We expect the Fed to cut interest rates, as I suggested. The argument there is largely on stability grounds, financial stability grounds, but also with inflation falling away, it's going to be very, very difficult for them to sustain Fed funds rates at these real implied levels. So the next 12 months are likely to see rising global liquidity. They're going to see falling to low inflation. You've still got a relatively high carry at the front end of the term structure, which may well lure people into cash, but I still think that you're going to get better returns probably out of equities. And in terms of the longer term, we figure that monetary inflation is still the order of the day. That's the bogey that everyone's got to overcome. And that's what asset allocation needs to steer towards, monetary inflation hedges. As the text at the bottom says, we still think that longer dated US yields have the ability to retest that sort of 5% level or above 5% level, largely because term premium just still look very, very depressed in a world where there's got to be a lot more coupon issuance coming. To refresh the background, what is global liquidity for those who are uninitiated there? Global liquidity is basically a pool of funds that flow through global financial markets. In aggregate size, that's 170 trillion US dollars. It easily eclipses world GDP. It's 1.75 times as big. And as we say in the text there, it's all about the capacity of capital, not the cost of capital that's important. This is particularly true when you've got a lot of debt to refinance. Global financial markets turn from new capital raising mechanisms into debt refinancing mechanisms. And it's that role which is important for financial stability reasons. And that's why liquidity is critical to understand. In terms of how we measure it, just briefly a recap. We're looking at the asset side of credit providers' balance sheets. That coverage comprises both or all of central bank interventions, bank and shadow bank credit, corporate cash flows, collateral-based wholesale and repo market activity, and net foreign flows. It is not, and we keep emphasizing this, money supply. And I think that's a concept that is very foggy and I think very misleading right now. Liquidity is a wholesale measure of liquidity that is really gauging the amount of cash that's going through financial markets. Here is our global liquidity cycle. It is drawn up as an index between 0 and 100. It has an average of 50. That's a rolling 3 to 4 year mean. And you can see the cycle illustrated there. Asset price booms tend to occur at the peak. Banking crises tend to occur at the trough. The US regional banking crisis earlier in 2023 is another heads up to why that cycle is working pretty much on track. And it looks as if that cycle is expanding. And as I'll show later, it probably reaches a peak sometime in late 2025. How do we think about liquidity? We think about liquidity in this way, using this inverted pyramid diagram. Basically, global liquidity is at the top of the chart, 170 trillion aggregate. That is effectively lent out by the private sectors worldwide, private sector credit providers. That rests on a base. We call that the shadow monetary base. It includes central bank money, is the black triangle there. It includes cross-border flows, although they're much smaller in size than they were probably a decade ago. And it also includes a large and growing pool of collateral, which is also very important because almost all lending now requires some sort of collateral backing. That shadow monetary base is around about $100 trillion in size, which means there's a multiplier between the shadow monetary base and global liquidity, which we generically call a collateral multiplier of about 1.7 times. Question is, are central banks easing? This heat map tries to decipher that. The red splodge in the middle of the diagram occurring around middle of 2022 is when central banks were at their tightest. The green for go perhaps as a traffic light is suggesting they're easing aggressively. We're starting to move into that green phase. You can see how the hues, the color hues in that chart are changing from red to orange and increasingly to some sort of pale green or yellow color. That's upcoming. So you can see how this evolution of central bank easing is underway. One example of that is what the Federal Reserve is doing. We've made the case through this year that we can see the Fed undertaking some sort of stealth easing, if that's the right way of putting it, or if you want to put it another way, more prosaically, you can say that there's maybe a quantitative support going on that the Fed is not really fessing up to. That's shown by comparing the red line in this chart, which is the size of the Federal Reserve balance sheet, which is what the media and a lot of pundits quote. That's the wrong thing to look at, by the way. It compares that to the orange line, which is net liquidity inflows into the market created by the Federal Reserve. The point being is that not every item on the balance sheet or balance sheet activity is necessarily liquidity creating. What we're really talking about in liquidity terms is money that is fed into US money markets. And that's the key point. That's the orange line. You will see that ever since the British gilt crisis in September of 22, that orange line has either flatlined or more recently since the SVB and First Republic crises in March of 23 has been trending higher. The dotted lines on the chart show what the implication of the original QT program suggested. And I think it's pretty clear the orange line is at least $1 trillion above that benchmark or that guideline. So the Fed is clearly doing something that it claimed it would never do, and that's adding liquidity. Where is the Fed on its timeline? And I've shown this chart a number of times before over recent months to say that the Federal Reserve is moving on track, largely on track, with a benchmark that we used, which is the 1997 to 2003 cycle in black as the dotted line. It basically was following that, but latterly in the last few months, it's steered off course. So Fed liquidity injections have largely flatlined. I mean, they've been going up a bit as we've suggested, but they've got to go up a lot more. And that would suggest that the dotted line is going to start to come into play pretty soon. In fact, one can argue that if you look at the reverse repo account that is on the Fed balance sheet and note the fact that Chairman Powell signaled that rates may be cut quite aggressively in 2024, that a lot of that reverse repo money is going to start to flip off the Fed balance sheet into Treasury bills because reverse repo is overnight money. Treasury bills clearly are term money. And a lot of the money funds will start to prefer term money in a falling interest rate environment. This chart summarizes what central banks are doing. This shows very clearly that the orange line, which is a measure of the liquidity that is injected into markets by the central banks weighted by size or the impact of that liquidity, that is going up quite clearly there. It bottomed, as we said, in late 2022, has been rising pretty consistently ever since. The dotted line is a count of the number of central banks that are easing, shown as a percentage. So we've got about a third of central banks now worldwide that are currently in easing mode. So we're through, we think, the worst of the monetary tightening episodes. The other component of global liquidity is look at this collateral multiplier. So we've got the shadow monetary base, but how many times is that levered up? The shadow monetary base can be expanding, but of course, if the collateral multiplier is shrinking, that's not going to have a positive effect on global liquidity. It will be offset. So we need to see a rising collateral multiplier. That is underway. You can see there the movements of the collateral multiplier over the longer term. The upward trend in that line is largely dictated by technological factors, or if you like, improvements in financial innovation, which tend to cause it to improve. In other words, the whole structure of the lending markets, the collateral markets tend to improve. There's more efficiency gains which come in, and the collateral multiplier tends to be bigger. Another factor, pushing this which has pushed this up over time has probably been falling interest rates and low inflation. But those are other factors to take into account. Generally speaking, the cyclical swings in this collateral multiplier are dictated by bond volatility. You can see that very clearly in this slide. The orange line is the year-on-year change in the collateral multiplier, and on top of that, we show in black the move index inverted. And what you will infer from the chart is that if the move index continues its path of fall back towards its long-term average of around 70, which is consistent with about 7% bond volatility across the curve, that would suggest that you've got further gains in the collateral multiplier to occur. All in, what does this mean? This is the correlation between global liquidity in orange and all wealth. The black line is a portfolio of all assets worldwide, residential real estate, all equities, all bonds, all liquid assets, crypto, precious metals, everything's thrown into that mix. It's a portfolio of about 500 trillion US dollars, so it's a sizable amount. And the black line is showing the annualized returns, or the annual returns on that portfolio. The orange line is global liquidity. Global liquidity is a driver of that asset price cycle. As you can see, the correlation, as we've noted before, through the last 10 years has tightened considerably. If you go back even prior to the commencement of the chart in year 2000, the correlation was good, but not as tight. It's tightened over time. The dotted line is what we extrapolate. Don't worry about the dog leg in the chart. The fact that we see a dip now, that's a base effect because of a big surge in liquidity and asset markets a year ago. But effectively, what you're seeing is a continual gain, and you're looking at liquidity of increases of something like 8 to 10% over the medium term. This is how we frame the implications. This is our asset allocation work. It basically shows the cycle moving ahead of the economic cycle. That is the liquidity cycle moving ahead. It has 4 regimes, investment regimes: turbulence, rebound, calm, speculation. It leads the risk or economic cycle by about 15 to maybe 18 months, or that sort of time frame. The overall liquidity cycle lasts about 60 to 70 months, and it moves sequentially through those 4 phases. The blobs on the chart, the red in particular, is showing yield curve inflection points. So what you would typically see is the liquidity cycle inflecting first, then the yield curve inflecting, then an inflection in risk appetite in markets, and then ultimately an inflection in the real economies. And it's that sequence, or consistency in that sequence, that we look for. This is where markets are positioned in terms of national identifying national markets. So what we're looking at here is the percentage of countries that are in each zone. You will see that the green, which is the more benign areas of rebound and calm, which you can go more risk on, are becoming a bigger and bigger part of that chart. The red, which is turbulence, which is where you don't want to have risk assets, is declining all the time. There's still a tail in that, but generally it's being increasingly swamped by the green areas. And that's what we continue to believe is the case. This traffic light chart then identifies what asset classes on the left, which industry groups on the right are appropriate for each season or investment regime that we identify. In rebound, you tend to want a more neutral beta. You can be slightly risk on in that phase. Equities and credits should be the best asset classes. Commodities and bond duration the worst. And then if you look at the industry groups, it's dominated by cyclicals and particularly technology during the rebound phase. And you don't want defensive stocks during that phase. And that's more or less how this year has unfolded. And therefore, we can be very reassured that the cycle is what we deem to be a normal cycle. I should say that this chart does not change very frequently. It's pretty much set in stone. It's based on historic evidence. And so it's unlikely to flip around. In other words, you can move between rebound, calm, and speculation, but which asset classes perform within each regime is more or less set in stone, often based on experience. To give you a heads up as to what's happening, this is our measure of the credit cycle in the US based on spreads. So in other words, a high reading here is saying a very wide spread. And what you can see is the history of the credit cycle. And you can see that it's inflecting now, which would tend to suggest that the credit conditions are broadly improving. That's quite consistent with the performance we've had generally in the credit markets this year, as that previous traffic light signal indicated. The orange is the US ISM. You tend to find that the credit cycle leads very slightly the ISM index, and the two are more or less moving together right now. So again, a reassuring sign, I think, for investors. We would envision that those two lines move down on the page, which is saying that the credit cycle improves and the ISM, which is inverted, starts to bottom and improve. Here is an AI model that we put together, shown in orange, based on commodity prices, credit spreads, again, and currencies of trade-sensitive countries, exporters, in orange, and that's showing what the business cycle is saying. The dotted line is what I've dubbed before the Stan Druckenmiller index, his favorite economist, as he deems it or labels it, to say this is the performance of cyclical stocks and versus defensives, and that tends to move very, very closely with the business cycle. And this looks entirely consistent with a cyclical pickup. That's what the markets are telling us. We never, never, never use macroeconomics to predict the market. We use the market to predict macroeconomics, and that's what is our sequence analysis. Liquidity leads the markets, particularly the bond market first, then migrating through other asset classes, including their equities and commodities. Those financial markets then lead the real economy. We like the consistency, but we never use macroeconomics to forecast either liquidity or the market movements. Here is an interesting chart to ponder because it says there's a lot of easing coming. The orange line there picks up on the previous chart, and it uses the data we've got for our AI-based model, and it compares that with business surveys. And what it's saying is that if this hard data from prices, commodity prices, that is, exchange rates, credit spreads, is telling you something a lot more positive than business confidence surveys, which is true now, that ratio is a lead indicator to monetary easing. And you can see how consistent that cycle is. So in other words, because you've had this improvement in hard data about what the economy is doing relative to what the business surveys are saying, that would actually argue there's a lot of easing coming. Now, the explanation of that may be, maybe a bit of a head-scratching one, but I figure it's all because lobby groups and industry who are petitioning the Fed and policy makers to say that things are bad, you've got to ease, you've got to add support, basically are doing that. By the time the Fed actually gets around to easing, the economy has already automatically been in a recovery mode. So they're actually easing as the economy is reviving. And so basically what that says is you get a further goosing of economic activity. This is another measure which I quite like, which is saying, well, okay, let's just believe that the Federal Reserve and the Treasury here are, by all their manipulations, really distorting the yield curve and the risk-free rate, which I think is not a bad, sort of prognosis to make. So therefore, what we've done is we've actually estimated the risk-free rate on the 10-year bond from the private sector markets, in other words, corporates and mortgage, particularly mortgage-backed securities. And that gives us the dotted red line that you can see on the chart. Now, the orange line is the 10-year Treasury, as stated. And you can see that the red dotted line is a ceiling, that the government market never trades through. But you actually see varying degrees of displacement between the orange and the red lines, which are picked up and measured by that black line at the bottom. Now, if you plot that black line at the bottom on a longer term scale, this is daily data we're showing here. What it looks like is this chart, again with the policy biases, we call it, shown in black. And that gives an interesting 15-month heads up to what the US Fed liquidity cycle is doing. Now, this is not, that closely correlated, but it's actually meaningfully correlated, and it's captured most of the big inflections in Fed liquidity. And what it's really saying is that if the Fed and the Treasury are trying to, as best they can, offer, if you like, backdoor support to the markets through their various programs, like whether it be moving towards bill issuance, or whether it means, running down the Treasury general account, or whether it means, running off the RRP, or whatever these various facets of policy are, that is picked up by that black line. And it's saying that they're sort of working very hard to try and restrain the markets, and then they let the brakes off, and you see this sort of major expansion in liquidity. And that's what seems to be upcoming right now. So again, these rather left field or unusual alternative, if you like, indicators are telling us the cycle is picking up. And that's what we want. That's the message from the markets as well. And that's very reassuring. So putting this together, what does it mean for the global liquidity cycle? Well, this is a familiar chart for those of you that listen to us. This is the liquidity cycle that dates back to 1970. The dotted red line is based on a Fourier series that we estimated up to year 2000. So it runs from 1970 to year 2000. We did it real time, and we've just extrapolated that Fourier series forward to show what the cycles are doing. We haven't fixed them, so what you see is what you get for the last 25 years, and it seems to be running its course pretty much on track, particularly through this COVID crisis. And what that would suggest is that October 22 was a real bottom, and late 2025 is likely to be the next peak. And that's what we've got to start to think about in terms of the liquidity cycle. Therefore, the wind is behind us now as investors. We don't face a headwind, and that's important. What about liquidity and the yield curve? What does that chart really tell us? Well, if you plot that long-term liquidity cycle in orange here, for the US alone, this is US domestic liquidity, and put on top of that the yield curve, and so we don't get muddled by, is it the 210 or the 510 or the 1 year, 20 year, or whatever the people's flavor of the month is. What I've done here is to use an average yield curve that I've called the intensity measure. This is available in the literature. What this basically shows is how the yield curve slope on average tends to move over time. So it's an unambiguous measure, and I quite like this. What it shows is the liquidity cycle is leading the slope of the yield curve pretty consistently over that time frame by around 9 months. The upturn in liquidity should be telling us we're beginning to get an inflection in the yield curve. So yield curve is basically moving towards a steeper gradient. I firmly believe that the Federal Reserve has to get the yield curve steeper to protect the regional banks. You need a steep yield curve for the banks to make profits. It is unthinkable to have a regional bank crisis in a presidential election year, and I think the Feds and the Treasury will be going for it to try and stop that happening. So I think they've got to have a steeper yield curve. So then you start to think, if you've got to have a steeper yield curve and you're limited, or you're limiting the amount by which Fed funds can practically be cut next year, then you're going to have more pressure on the long end of the bond market, which is something that I firmly believe is still underway. So this rally in bonds, I think, is going to fizzle out pretty soon, not least because we're also in the camp that says there's no deep recession occurring in the US. Which brings me onto the bond market here. This is a daily plot looking at what the implied terminal policy rate is for the US 10-year bond, extracted from the 10-year bond. This is the terminal policy rate in black, and the term premium on the 10-year in orange. What you can see is the rally in the 10-year has been engineered of late by a fall in implied terminal rates, which is quite consistent, I think, with what we've been seeing, as well as a reversal in the term premium, which is not consistent. I think that term premium has to reverse course and go up. One of the things that's driving it will be new issuances, you'll see, but I think that has to get back to zero. So I think there's a lot of upward pressure on the back end of the curve from rising term premia in this sort of brave new world that we're looking at. Term premia are not just a US phenomenon, they're a global phenomenon. They tend to move together. What you'll see here is the correlation between 10-year bond term premia. And if you look closely at the chart, you'll see that Japan in many ways is leading the world in terms of term premia rising. And what is happening in Japan right now with rising inflation and let's say some muddle in monetary policy is likely a backdrop for rising term premia there. US will likely follow, other countries are following too. And this latest setback in term premia is purely a trading blip in our view. Term premia have got a long way to go to renormalize, and that's what that chart is saying. In the case of the US, what is the correlation between term premia and issuance? We've called this collateral, which is really the supply of duration for US investors. It assumes a normal level of foreign buying of US debt. That in itself may be questioned. It assumes a normal level of Fed QT, which again may be questionable. So there may be that may come out of the equation as well. But broadly, what you're seeing in this case is a very, very close correlation between the term premia. This is adjusted for inflation and volatility. So it's the underlying supply-demand dynamics and the supply of duration into the market. Looks like term premium have got to move up towards this zero threshold, as we indicated. This is the challenge that is likely to be faced. The black line is using Congressional Budget Office projections as to what the effective supply of duration is likely to be doing over the next 4 or 5 years. I put them alongside what this Congressional Budget Office also thinks the Fed balance sheet, or Fed the implied level, I should say, of Fed Treasury holdings are doing. In other words, they're dropping a bit, then they pick up or they stabilize. I think that is way, way too conservative. The Fed has got to play a bigger and bigger role in this whole equation. And as we keep saying time after time, month after month, debt means liquidity, liquidity means debt. The whole thing is there's an axis there, a linkage, which is very, very difficult to break out of. This is the debt background for the US. You'll see here that the orange line is showing the debt GDP ratio for the US. The dotted red is the same for the UK. It stretches back to 1800. It is data that's come from the IMF and the Congressional Budget Office. The projections there, which show that the US debt GDP ratio is testing 250% by 2050, is we think quite a realistic estimate, and that's the course we're on. That is a danger course, of course, but there we are. That's where we are. We've got what we've got here, and that's all because Medicare, Social Security are blowing out. Defense spending is going to have to come through at a faster clip, etc. And this is the reality that it faces. That what you've got here is, for the advanced economies, a stable debt liquidity ratio across the world economy since 1980 at about 250%. So in other words, the stock of debt is always about 2.5 times the amount of liquidity in the system. So liquidity has to expand as debt expands. The only way that liquidity, we think, would drop away significantly is if somehow we fix the debt problem. That is not going to happen as far as I can see. Debt is on an explosive course, which means liquidity is too, which means you're getting monetary inflation, and asset allocation has to adapt accordingly. These are our projections of the Federal Reserve balance sheet over the next few years, with the orange bars showing the Congressional Budget Office figures, and the grey showing ours. The percentages above the bar is what the percentage increase in the Fed balance sheet is. And what we've done is we've assumed you get extra defense spending and slower QT, because as soon as rate cuts start, we can't see the Federal Reserve running off bonds anymore. So that would suggest that what you've got there is some pretty solid gains. However, Fed balance sheet is not Fed liquidity, and Fed liquidity is probably growing faster than this because of various nuances within the balance sheet. And this is our projections of what Fed liquidity is doing, again with the percentages reflecting the annual increase year after year. Now, you could accuse us of saying this is a very racy forecast, and maybe it is. We think it's a prudent forecast. It includes, as I say, a little bit of or more defense spending, up to 5% of GDP. It includes a little bit more Medicare and Social Security, and it assumes that the RRP program is run down. But this is what you could be getting. And even if you take the CBO numbers in orange, there's still a noticeable increase in Fed liquidity occurring over the period. This is the breakdown of how we analyze Fed liquidity. The darker orange bars are the CBO numbers, the Congressional Budget Office numbers. What we've done is we've added to that through a slower QT program and more defense spending, and that's how we get the numbers we get. As I say, you can fiddle around with this and get a lower figure if you like, but that's what we think is happening, and that's the backdrop we're facing as investors in markets. If that's the Fed story, what about China, the other most important central bank in the world economy? This is what China has been doing since June, or sorry, has been doing over the past year or so. And since June, you can see that there's been a noticeable uplift in their liquidity injections. China has changed direction. In the prior pre-June period, it was very clearly trying to protect the yuan. That was a mainstay of policy over the previous 2 to 3 years. They tightened a lot last year during the COVID upheavals, or despite the COVID upheavals, to try and protect the yuan. What they've done since June is injected a lot of liquidity into their markets, totaling about 5 trillion yuan, to try and get the economy stimulated. That is likely to be an ongoing process. If the economy remains sluggish, they will put more liquidity to work. The yuan hasn't been lost sight of, but whereas they had all eyes on the yuan a year or so ago, they've only got one eye on the yuan now. We think the yuan has to devalue to about 8 against the US dollar ultimately, but the firmer the yuan is in the near term, the more liquidity is going to be thrown at markets. That's what's going on. This is the impact that China's PBOC has on the world economy. I took an anodyne measure, if you like, of the world economy by looking at a shipping activity index that we put together for the Asia Pacific region. This is taking evidence from Singapore, evidence from LA and Long Beach, as well as container traffic from China. And this puts together an index, and that index shown in black happens to correlate remarkably well with the Chinese liquidity cycle, with Chinese liquidity here advanced by about 3 months to show that it's a leading indicator. And what you can see here is that the cycle is very evident from what the PBOC does. In other words, if you think the Federal Reserve is critical of financial markets, China's People's Bank is absolutely critical for the tempo of the world economy and hence commodity markets. Let me finish with some thoughts on the dollar. Why has the dollar been so strong in the last few years? The answer is very simply capital flows. Capital flows have been winging into the US dollar pretty much since the end of the financial crisis, but notably since 2011-12 and the Eurozone debt crisis. What you've seen are very high levels of inflows shown by the orange bar. That's been helped by big outflows from China around 2015, 2016, the COVID crisis, and also the sort of the general background of Basel III and Solvency II, which have increased the demand for US safe assets. All these factors matter, but it's pushed the dollar up. In terms of the impact that capital flows and policy are having on the dollar, the black line shows deviations from the trend in the trade-weighted dollar, the DXY, shown as the black line. The orange line is our prediction based on evidence of capital flow and policy shift in terms of liquidity. In other words, liquidity injections. You can see there that what we're projecting is some fallback in the dollar to test its trend, but that's nothing too severe. It's really a move back to trend. We still are bullish in the medium term about the dollar as a paper unit against other paper units. But we've got to accept the fact that a big Fed easing is going to pull the dollar down back to its trend. This is what the trade-weighted dollar should look like, taking into account both the trend and that cycle. In other words, what you see is the dollar pretty much holding up as a paper currency unit through this period. It comes off its peak a little bit, but nothing too severe in our view. But that's broadly how this works. The predicted line is a rolling 12-month forward indicator that we've been doing over that period. This is the correlation between gold and global liquidity. That is a compelling relationship. You'll see from the table at the bottom, there is a Granger causality test that we highlight, which shows that liquidity unambiguously leads gold prices by 6 months. That the evidence is there on that table. The orange line is suggesting a close correlation, close positive correlation. And as global liquidity, or as we call it, monetary inflation, starts to pick up, the gold price is a great barometer of that. You can see that in this final chart, which is basically highlighting what we call monetary inflation hedges, shown in orange, which is the crypto universe and the stock of gold. This is valued in terms of trillions of dollars on the left scale as a total stock. The right scale is showing global liquidity. We've extrapolated that forward to 2025. So in other words, the black line in the future is our projection. The orange line tends to track around that quite closely. So in other words, that as global liquidity expands, that's monetary inflation, and that is causing gold and crypto to rise. You can dub, if you like, crypto as exponential gold, which we did slightly tongue-in-cheek in a recent report, but it does tend to be very, very liquidity sensitive. And as we keep stressing, these assets are monetary inflation hedges. They are not necessarily high street inflation hedges. And just for the record, the dotted line at the bottom is US CPI. Since 1995, global liquidity has expanded by 5-fold. The price of gold has gone up by 5-fold, and US consumer prices have only doubled. So you can see there that monetary inflation is the watchword. And generally, we think this environment is benign for monetary inflation hedges. It's good for equities, we think, certainly for the next 12 months or so. That's where we're positioned. And you would envision that the cycle moves on to the next phase at some time in 2024 towards calm, when you've got to start looking for the first evidence of that, which is some pickup in areas such as commodity prices, a pickup in things like financial stocks, and some increasing traction of energy shares as well. Those are normal heads up for a movement into the calm phase, and that's what we're going to be looking for. And also, I would suggest that you're going to be seeing some evidence, at least globally, of a stabilization in economic activity. So we think it's risk on. We think liquidity is going up. Have a very happy holiday, and we wish you a very successful 2024. Thank you for listening.